Hello everyone, welcome to the weekly lecture videos. In this video, I continue to discuss the concept of diversification and systematic risk. Now that we know how to construct portfolios and evaluate their returns from the last videos, we begin to describe more carefully the risks and returns associated with individual securities. Thus far, we have measured volatility by looking at the difference between the actual return on an asset or portfolio and the expected return. Let's discuss briefly why such variation exists. To begin, let's consider the return of a share of a company called Flyers. What determines the return of the shares in a coming year? The return on any shares traded in a financial market is composed of two parts. First, the normal expected return for the shares is part of the return that shareholders in the market predict or expect. So that's called expected return. Okay. This return depends on the information shareholders have that affect the shares, and it is based on market's understanding today of the important factors that will influence the shares in the coming year. The second part of the return on the share is the risky part. This is the portion that comes from unexpected information revealed within a year. Okay. A list of possible sources of such information would be endless, but a few examples could be news about Flyers research, government information release on GDP, the result of latest global warming negotiations, an unexpected drop in interest rate, and so on. Okay. So based on this discussion, one way to express the return is unexpected return plus expected return plus unexpected return. So R here stands for the actual return in the year, and ER is the expected return, and U stands for unexpected. What we say is that the actual return differs from the expected return because of surprise that occurred during the year. In any given year, the unexpected return will be positive or negative, but through time, the average value of U will be 0. Okay, so this simply means that on average, the actual return equals the unexpected return. Okay. The unanticipated part of the return, that portion resulting from surprise, and as we have discussed in the last slide, is the true risk of any investment. After all, if we always receive exactly what we expect, then the investment is perfectly predictable and by definition risk-free. In other words, the risk of owning an asset comes from surprises, unanticipated events. There are important differences, though, among various sources of risk. Look back at our previous information, previous example in the last slide. Some of them are directly related to Flyers, for example, the news about research. Some of them are more general, for example, interest rate changes. Okay. So this is what makes a difference in different sources of risk. Okay. Now, the first type of surprise, the one that affects a large number of assets, will be labeled as systematic risk. Okay, because systematic risks have market-wide effects, they are also called market risk. Okay, systematic risk is also called market risk. The examples of systematic risk are you can see the changes in GDP, inflation, interest rate, and so on. Okay. So this type of risk essentially affect all the securities in the market. Okay, so that they systematically affect them. That's why they are called systematic risk, and due to their market-wide factor, market-wide effect, they are called market risk. The second type of surprise we call unsystematic risk. Okay, so unsystematic risk is the one that affects a single asset. or a small group of assets. Because such a risk is unique to an individual company or asset, it is sometimes called unique risk or asset-specific risk. Okay. As we have seen, uncertainties about general economic conditions such as GDP, interest rate, inflation rate, economic change in other economic geopolitical conditions. So they affect all companies to some degree. Okay. For example, an unanticipated rise in inflation affect wages, cost of supplies, that affect the value of the assets of companies, so it affects the prices of all shares. In contrast, the announcement of an oil strike by company X will primarily affect that company, or maybe a few others. So it is unlikely to have much effect on the world market. Okay. So that's why there are a systematic and unsystematic component of return. Okay. Now, look, the reason we are differentiating between these two types of risk, systematic risk and unsystematic risk, is unsystematic risk is risk specific to a company, and this risk can be eliminated by forming a very well diversified portfolio that includes large number of stocks in the portfolio. Systematic risk, on the other hand, cannot be diversified away or cannot be eliminated because it is associated with general changes in the market, so that affect all stocks. That's why in a marketplace, you can only expect a reward for the systematic risk. Okay, so you cannot expect any benefit for taking unsystematic risk because that can be diversified away as we include more and more stocks in your portfolio. Okay, so the expected return will essentially be depending on the systematic risk of a stock. So we already discussed the unsystematic risk already, like labor strikes and part shortages. Okay, and since it can be eliminated, you cannot expect any reward for taking unsystematic risk. Okay. The distinction between a systematic risk and an unsystematic risk is never really as exact as we discuss here. Even the most narrow and particular bit of news about a company ripples through the economy. This is true because every enterprise, no matter how tiny, is a part of the economy. It is like the tale of a kingdom that was lost because one horse lost a shoe. This is mostly here splitting. However, some risks are clearly much more general than others, as we have seen the examples. Okay, the distinction between the types of risk allows us to break down the surprise portion, the unexpected portion of the return of flyers into two parts. Okay, from before we had actual return, we had total return was expected return and unexpected return, right? So that was our previous equation. Now unexpected return, that means the surprises can come from systematic portion as well as from unsystematic portion. Okay, and that's why total return should be composed of expected return and systematic portion of the unexpected return and unsystematic portion of the unexpected return. So these three components combined make up the total return. Okay, and the important thing about the way we have broken down the total surprises is the unsystematic portion. Okay, so the unsystematic portion, this is what I'm talking about, is more or less unique to flyers. For this reason, it is unrelated to the unsystematic portion of the return on most other assets. Okay. Now we bring back the concept of diversification once again. You probably recall that we introduced this concept in the last video. We have seen earlier that in principle, portfolio risk can be quite different from the risk of assets that make up the portfolio. Okay, so we now look more closely at the riskiness of an individual asset versus the risk of a portfolio of many different assets. Okay, so you see that the portfolio diversification is essentially investing in different asset classes, and within asset classes in different securities. Okay, different securities. As a result, there will be some offsetting impact of the risk of one asset or one asset class by the other. Okay, just to give you a quick example, that if you own 50 internet company shares, you are not diversified. However, if your 50 share coming from 20 different sectors, then 20 or 30 different sectors, then you are diversified. Okay. Now in chapter 10, if you remember, we saw that the standard deviation of annual return of all ordinaries index, a portfolio of ordinary shares in the top 500 ASX listed company has historically been 13.6% or so. Okay, so does this mean that the standard deviation of the return is typically on a typical share in that group is about 13.6%? As you might suspect by now that the answer is no. Okay, this is an extremely important observation. To examine the relationship between portfolio size and portfolio risk, look at this table here. Okay, this table illustrates typical average annual standard deviation for portfolios that contain different numbers of randomly selected ASX securities. Okay, so you see that when there is one stock, the average standard deviation of return is this. And you see that as the number of stocks increases, the average standard deviation typically decreases. Okay, average standard deviation typically decreases. So you see that it's 11.49% for one, for example, and when there are 45 stocks, then it is 5.12%. So what this means is that if you randomly selected the shares of a single ASX company and put your money into it, your standard deviation would be 11.49%. On the other hand, if you were randomly selected 45 shares and invest each of them in equal proportion, then the standard deviation will be just about 15% or so. Okay. Now, the principle of diversification, as we have discussed, that diversification reduces the variability of return, okay, variability of return without reducing the expected return. And I already mentioned that this reduction in risk arises because one asset offsets the risk of another. Okay, however, we already discussed that a certain level of risk that cannot be diversified away because of the systematic nature or systematic portion of these risks. So you can see that total risk essentially is a combination of systematic risk and unsystematic risk. Okay, and standard deviation is a measure of total risk. So when we calculate a standard deviation of a portfolio, that actually captures both systematic and unsystematic risk. And we already mentioned that the unsystematic portion of the risk will be very small for a well-diversified portfolio because we diversify away the unsystematic portion of the risks. Now, how do we measure systematic risk? So systematic risk can be measured by what we call beta coefficient. So beta coefficient essentially is a measure of how sensitive an individual asset return to the market return. Okay, So you see that systematic risk, systematic risk means the risk that comes from the market-wide factor. For example, interest rate changes, inflation rate changes, and so on. Now, for these market-wide factor changes, the overall market will change. Okay, so this change in overall market will bring the change in individual assets. But obviously, each asset will not respond similarly to the change in the market. Okay, now the beta of an individual asset is an indicator that how sensitive an individual asset to the market. Okay, obviously, a higher beta indicates a higher systematic risk because it indicates that the individual asset return will increase at a higher proportion for a given change in the market. On the other hand, if a beta is lower, that indicates that it has less systematic risk. So you can see that a beta of one implies that an individual asset has the same systematic risk as the market. So which means that, let's say, a market changes by 10%, that individual asset return will also change by 10%. So it's systematic risk of the overall market or the diversified or the well-diversified portfolio, and the asset in consideration has the same systematic risk. If beta is less than 1, so the asset has less systematic risk. For example, if market changes by 10% and the beta is 0.5, it means that this individual asset return will change by 5%. On the other hand, if beta is greater than 1, it implies that it has a higher systematic risk. For example, if market changes by 10% and beta is 1.5, that individual asset return will change by 15%. Okay, so this is how we get an idea about the riskiness of an asset, a systematic risk of an asset, which essentially is the sensitiveness of an asset return to the overall market movement. So you see that beta coefficient of some selected companies are this, indicating that the level of their systematic risk or level of their sensitiveness to the overall market movement. Okay, now an individual asset has its beta, which is its systematic risk. Now, when we are talking about a portfolio, then we also need to calculate portfolio beta. So portfolio beta is calculated as in a very similar way we calculated the weighted average, the expected return of a portfolio. So you can see that this is the beta of an individual asset and the weights of that asset in that portfolio. And then as we sum them up, we multiply and sum them up, we get portfolio beta. Okay, so for example, share A, B, C, and D have their investment. Okay, individual investment. So from this investment and total investment, we can calculate their weight, and these are their individual asset beta. Sorry, individual asset beta. And if this individual beta is multiplied by their weights, that is calculated from amount invested, and then we sum them up, we get the portfolio beta. Okay, so just to remind you once again that the systematic risk principle states that the reward that you can expect is just for bearing systematic risk, because systematic risk cannot be diversified away, and you know how to measure systematic risk, which is beta, and beta is essentially the sensitiveness of individual assets to the market movement. Sometimes to understand the risk-return relationship of an asset, we calculate what we call reward to risk ratio. Okay, and reward to risk ratio, this is also known as Sharpe ratio. Okay, so by this ratio, we essentially calculate the excess return for per unit of, you can see that per unit of systematic risk. Okay, so beta is the systematic risk. So you see that when you invest in an asset, okay, and you take its systematic risk, and here is the excess return that you get for taking this systematic risk, and this reward to risk ratio will be measuring the per unit of excess return for every unit of, the level of excess return for every unit of systematic risk you take. And obviously, the higher this ratio indicates that the higher return you are earning from an asset in relation to the asset's systematic risk. Okay, and as we compare them, for example, the reward to risk ratio of this asset and reward to risk ratio of this asset, we can compare their risk return relationship. Okay, so higher reward to risk ratio obviously indicate that you are earning higher return in relation to its risk. Okay, so this is just a graphical presentation of what I have just indicated or what I have just discussed. So you can see that here in the horizontal axis, you have beta of the asset, and in the vertical axis, we have expected return, right? And you see that as beta is here, expected return is here. As the beta increases, that means systematic risk increases, then the expected return of the assets increasing. So higher systematic risk is compensated by higher expected return. Okay. So this is the end of our discussion on expected return and systematic risk. In the next video, we will continue to discuss the Z-theta trade-off using security market line and capital asset pricing model. Thank you very much.